Hey guys, thank you so much for joining me. It's Call Me Cookie here with my latest video. I apologize, I've been away for a good while. I had to move and, new house, completely new state. I actually ended up selling a good portion of my crypto portfolio to finance my move, but I'm not too down in the dumps about it. The vast majority of my portfolio was in leveraged yield farming, but it's all stable coins. So, I mean, really all I did was just take all my stable coins out of my pools, convert them into USDC, and then sent it on over to my bank after, of course, converting it to normal US dollar. So really all I've got to do is just, put my bank deposits back into stable coins and get myself back into my yield farms and all of that good stuff. And that's why I'm making this video today, because I want to take a look at where my portfolio is today so I can figure out where we're going to go, some of the protocols that we may consider, and why. Most importantly, why. If you're going to be doing any type of investing, right after you sit down and you do your budget and you understand what you can invest, you then need a thesis. Why? I want to have an additional stream of income in addition to my 9 to 5. I really like crypto, and I want to be able to have the same access to tools as those who have large amounts of wealth. And I really like the exercise of utilizing the tools that are in crypto. That is part of my thesis. Now, another part of my thesis is I do not look at charts all day and buy low to sell high, shorts, none of that crazy stuff. I don't have the time. So what I want to do is I want to invest in infrastructure. I want to invest in things that other people rely on. A really easy example of that is Ethereum itself. Other people rely on Ethereum as a way to host their smart contracts and allow other people to have access to their smart contracts. And when people interact with the smart contracts, there is a fee that is paid in the form of gas to the various participants that are maintaining the infrastructure. I can say, hey, maybe, or I have confidence that if I buy ETH, the more adoption, the more people that come access the blockchain and interact with smart contracts, they're going to need gas to pay for it. I buy it just for the sake of gas because I want to own something more like Synthetix. Synthetix is currently about 30% of my portfolio, and I will dig into exactly what it is and why. So Synthetix has a native token called SNX. Today, November 1st, 2023, it's trading at $3.34 just about. It's actually been doing really well. Synthetix is a piece of liquidity infrastructure that, as you can see down here, Quenta, Polynomial, Lyra, and even Curve use to facilitate cheap and efficient trades for their traders. It is a liquidity protocol, a liquidity layer protocol. Now, the way that they go about it is very unique and very interesting. I'm going to purchase the SNX token. I will come onto the platform and I will stake my SNX token. Now, when I stake my SNX token, I'm going to become a part of the community of collateral stakers. And people are going to bet against us as collateral stakers. Think about the fact that a casino is sitting with a bunch of collateral. They're at risk of losing all of that money in the casino because people are betting against it. So you're at risk of losing it by default because people are saying, I want that money. I'm going to put XYZ on one side of this bet. And then if I win, you, the casino, are going to pay me out. And that's exactly like a very easy way to conceptualize the way that we're interacting by staking SNX. When I stake SNX, the traders on all of these other platforms that I mentioned a few moments ago, they're going to bet on taking the dollar value of my SNX from the platform. But when they lose that trade, they pay us. And whether or not they win or lose to execute those trades, in order to execute those trades, they need to pay fees. And those fees come to us SNX stakers. Now, what that does is that allows me to get, at least today, around a 14.5% APR, and that is paid out in the form of SNX token every week. And that's very important because I work a 9 to 5 and I get paid every week. And now I have a routine of being able to rely on Synthetix to give me some form of payout, some form of return on a regular basis that's very consistent with how my life works. Work every day, paid every week, right? Keep track of my SNX collateral because it is a debt position, so I need to make sure that I manage my collateral ratio to ensure that I don't get liquidated. So that is SNX. So another really cool part of SNX is, again, when I go ahead and I stake my tokens, I'm going to be able to mint the SNX stablecoin, right? The SNX stablecoin is, again, also what the traders on Quinta are going to use to perform their swaps and their perpetuals, because on Quinta all of the coin pairs are with SUSD. So you have ETH SUSD, BTC SUSD, but I get to mint my own SUSD that I can go and use in the rest of the DeFi market. Now, first of all, I can mint it and not use it at all, because again, I can use the SUSD to manage my collateral, to manage my debt position, to make sure I don't get liquidated. So it is great to keep some SUSD as a backstop, or have some other asset in your wallet that you can then sell into SUSD to pay back your loan, or to purchase SNX so that you can maintain your debt to collateral ratio. I can take my SUSD, and the next Lego that I would always turn to is a lending and borrowing protocol. So something like on Optimism and Base, we have Sonne. So I can take my SUSD, come on down to Sonne, and just deposit it the same way that I would in a savings account at Bank of America or Capital One, whatever the case is. And I'll get an APY of almost just below 6%, and a rewards APY. So my supply APY will be paid to me in SUSD, and then my rewards APY in this case will be rewarded to me in the Sonne token, so the token of the protocol itself. And I can go in and I can take that Sonne token and sell it, or I can use it in DeFi and pair it with SUSD and get more yield. Um, I can borrow against the supply that I have deposited in Sonne and take out a loan that is, let's say, OP, because the borrow APY on OP is just over 9%, but my reward APR is just over 8%. So that will net me, depending on the conversion between the APY and the APR. You have to bear that in mind. I'm probably thinking it's going to be around 1% using very simple math. So the rewards are going to offset the loan that I take, and I'm getting rewards. I'm being compensated for my lending, and then I'm also getting rewards, right? So APY, APY, yield, right? Estimate. And then so I can then take the asset that I've lent, and let's say I go over to Velodrome and I want to stop playing with the super safe, below 20% yields that I've been getting so far. I can go on over to Velodrome and I can sell the asset that I just borrowed from Sonne, sell half of it for SUSD, sell the other half for Velo, and then deposit that liquidity pair into this pool and get a nice juicy 45%, almost 46% APR. When it comes to a protocol like Velo, things can get a lot more complex, because when I'm LPing, I'm going to be rewarded in, at the very least, in the Velo token. I know I don't have anything in my dashboard here. I probably should have pulled up the documentation, but you see these separate categories. So when I go over to my dashboard, I'll be able to see the funds that I've staked into the protocol. And then from that stake will end up getting liquidity rewards. Now I can take those liquidity rewards that are paid out to me continuously and occasionally harvest them, sell tokens to SNX, deposit them into SNX for more SUSD. And did I mention that the more SNX that I have staked, that will continuously increase the amount of fees and additional revenue that I will get from the Synthetix platform every week. So then that's how you create your flywheel. You always want a good cycle, a good flywheel. That is the basic flywheel that I have. Now, again, I use each one of these platforms in a couple of more I don't want to say advanced ways, but there's another few mechanisms that I am going to utilize on each one of these platforms to further increase my yield, but I've just given you the bare bones. Now, so that's honestly for ETH, right? Let me take a quick switch over to Solana, right? Because I'm starting to definitely build my Solana bag. I don't know, at least right now off the top of my mind, I think that overall I'm going to take my crypto portfolio, slice a third off, and I will have a third of whatever I'm doing in crypto. That's going to be on Solana, at least right now. Um, Hopefully, I start to get to like a 50-50 range, but I can't fight the fact that most of my yield is coming from optimism and from base. I actually do have a bit of stake on base. I also have a bit of stake on Aura. Again, in the comments down below, if you want me to dig into all of the other additional layers of yield that I'm getting, like Aura and all of that good stuff, definitely let me know and I can go into that in a later video, but I'm just trying to skim the surface right now. So, um, also, let me give you a quick justification as to exactly why I rock with something like a Synthetix. Is if we go over to DeFi Llama and we look at the simplified version of the fees and revenues, take a yearly approach to the amount of fees, because remember, Synthetix is going to pay out all of the SNX stakers and fees every week. Now let's do it that boom, out of how many protocols that are on here, hundreds of protocols, at least on this page, 266 protocols. Out of 266 protocols, the Synthetix protocol generates the 17th most. That is just a bit behind Optimism itself as a layer 2. And that's just behind Curve, which is one of the cornerstones of DeFi, period. Right? So the organization, the protocol as a business is profitable. And by me investing in being an SNX staker, I am a part of that business. I get my own little slice of that nice $30 million that were made over the last 12 months. That doesn't sound bad to me. And again, as I sell off my other rewards and I buy more and more SNX, the slice of that 30 million incrementally gets a bit bigger. Great. Now let's jump on over to what's going on with our Solana bags. I'm going to close this tab, and it's gonna be it's gonna be Jito. Jito is going to be the basis of my Solana bags, and I will tell you why. So again, I need a basic yield. I need a basic yield with anything that I do. Now with my Ethereum portion of my portfolio, that's going to be SNX. Now, when it comes to Solana, I think a great way to go is going to be using something like Cheeto, because for me, whenever I want to deploy capital into Solana, I'm going to, from my bank account, send purchase USDC on Coinbase, and then I can free transfer that USDC over to my Phantom wallet, so I don't have any transaction costs there. Um, and then I'm going to probably go to any decentralized exchange like Jupiter, and I'm going to buy Sol token. right? Then what I want to do is I want to make sure that I'm getting some type of yield. What's my first form of yield? I'm going to go on over to Jito. Jito is an MEV powered liquid staking platform. Right now, it's just under 7% yield. And trust me, this platform is making waves. Everybody's talking about it. Here, let's go on over to this screen. As you can see, up and to the right. But what Jito is going to let me do is I'm going to deposit Sol, and it's going to allow me to mint just about one to one the same value in Jito Sol. So for just having purchased my Sol token and then depositing it into Jito, I'll be getting a just about 7% return on that. Now, I can take my Jito Sol and I can deploy it into DeFi. First of all, if I don't want to hold Jito Sol, I can just sell it. I can take my Jito Sol and I can do pretty much the same thing that I'm going to do in Ether, right? I can do something like a MarginFi, a lending and borrowing platform. And this is exactly what I have right here. Um, on MarginFi, I have almost 5 Jito Sol staked, just under $300, and I'm getting. I think this is yielding nothing, pretty much nothing, pretty much like a traditional bank account. But then again, when I deposit those funds, I can borrow against it. I don't see anything here yet for a rewards APY, but the leverage I can use to then take out a loan and go and play in DeFi on something like Drift, where I can take my loaned assets and just deposit them here for a very safe yield. Drift has an insurance fund, and if you go and look at this insurance fund, did this stop? Hmm, I don't see it here anymore. Oh, it's off. Oh, oh, you know what? Um, the region restrictions on. I don't have my VPN on, and I don't see the reason to. Should I just turn it on? Is my PIA on? My VPN isn't on right now. The last time I checked, if I just deposit into this USDC fund on Drift, I can pull in about 10%, let's say just shy of 10%. So, that's yield. It's another way to make yield. I can trade. I can do all of these extra activities. I will cut the video there, but again, just a very basic take on what I'm doing in DeFi, how I'm thinking about restructuring my portfolio, and some very basic strategies. Let me know in the comments down below exactly what you would want me to dig deeper on, and I'd be more than happy to. If you like the content, please drop a like, hit that subscribe button so you are alerted when I do get back to you with the answers to your questions. And thank you so much for joining me, guys. I'll catch you later. It's been Call Me Cookie. Peace.